for holidays already. Let's get to Yu-Dee Chang, Principal, also Chief Advisor, ACE Investment Strategists. He joins us live from over in D.C. Yu-Dee, good to see you, and good evening your side. It's probably pretty cold in D.C. as well, all along the East Coast there. Not much is going on right now. Let's take the time to help viewers get set up for 2010 trade. This is a bit of commentary from a trader that we've been reading about. And he says, look, next year is going to be a better year economy-wise, but a tougher year stock-wise. It's going to be a show-me year. That is, they've done the hard stuff, cutting costs, etc. Now, show me growth, economy-wise and also earnings-wise. Fair?
Yeah, seems to be the consensus here. Basically, from the big fall-off last year was 2008 into 2009 and the tremendous bounce there, most people are saying the so-called the easy money has been made. Going forward, like you're saying, most people are slightly positive. However, you really need to start to pick the stocks now. So the easy money has been made. Going forward, it's probably going to be a little bit more choppy, and money is going to be a little bit more hard-earned.
Okay, and how is that money going to be more hardly or harder earned, that is?
If you think about this, in the U.S., you definitely still have a lot of positives. Basically, you have a 2.7% GDP maybe going forward to 2010. You do still have benign inflation, about 1.7%. If you look at the forward-looking PE on the S&P, basically $75, and that's about a PE of about 15. That is still pretty low. But you look on the other side, my God, you still have a 10.5% unemployment. So everybody around you is unemployed. You're just not going to spend too much. Of course, you still have the a problem in real estate, especially in commercial real estate. So going forward, you really have to pick the sectors, probably roll along with various different sectors rather than a overall a wide or broader market advance. Okay,
you're going to have to be a lot more sort of selective or specific, and probably be a lot more bottom-up in your approach as well. Let's talk about some of these problems you raised. Commercial real estate, a lot of people have been talking about this as the next shoe to drop. How concerned are you, and how do you hedge against that shoe dropping?
Yeah, it's kind of interesting. I think the shoe has pretty much already dropped. Don't forget, the market is a very efficient discounting mechanism. So it's not what we already know, it's what we don't know. I think we already know it's pretty tough in the commercial real estate, especially in the U.S. Arena here. But what's more important is it going to get worse? I think that's where the question is. I think basically most people are saying, in my own opinion, it's probably not. Basically, a lot of things that we know is already out there. Yeah. We know in the next 5 years, all the commercial real estate coming due, 43% of them right now in the U.S. is pretty much upside down, meaning that the loan value is actually over the property value. So that's already known. I think going forward, if we could get a sustained economic recovery, we're probably not going to get worse.
Yeah, it's that nasty situation known as negative equity. I understand it well. Yu-Dee, we'll get back to you in D.C. in just a bit. Yu-Dee Chang, Principal Chief Advisor as well at ACE Investment Strategy. Let's get back to Yu-Dee Chang, Principal, also Chief Advisor, ACE Investment Strategist, live out of D.C., staying with us from there. Yu-Dee, that piece of tape we ran was noting how, it all started with the popping of the tech bubble, then ended up with the popping of the debt bubble, this whole credit crisis. It seems as though we're kind of full circle right now because there seems to be a lot of opportunity as the new decade starts in tech. It's one sector that you like as well, right?
Yeah, definitely. I think the tech sector is a sector I like for a couple of reasons. One, the sector as a whole does have a lot of cash on hand. So as the economy recovers, if it does recover, it will have a lot be able to take advantage of. Number one. Number two, I think should the economy not recover as vividly, then the tech sector is a little bit less subjective to the so-called credit issues. So that's good. And also third, when the economy does recover, the entire sector, tech sector that is, does have the growth potential that I think is going to overpace the broader market. That's why I do like the tech sector.
Yu-Dee, what about the financials? Are they going to be the weak link in 2010, or are they on a more stable footing now? Because the story that we've been headlining, GMAC needing an additional almost $4 billion from the Treasury, that doesn't really fill people with confidence, does it, that these companies need more cash handouts from Washington?
Yeah, that's the problem. I remember about a month ago, we were discussing the fact that some company actually wants to get back the TARP money. The government is actually saying, no, 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 we don't want it back. We want to make sure that you are on very solid footings, that just in case we have a double dip in the economy, you're not going to come back to us and ask for more money. I think that's what the problem is, that nobody knows going forward, are we going to double dip in the economy here? So I think the financials, though, I think for one, who bets the fact that the economy is going to recover, then the fact the financials is probably going to be okay going forward, because after all, financials are the so-called lifeline or the lifeblood of the entire economy, entire market. So if you like the economy going forward, you will have to like the financials.
All right, and apparently you think the dollar's going to be okay or more than okay next year as well.
Yeah, and it's kind of interesting. From the fallout of 2008 into, I would say, March of 2009, a lot of people are pretty much driven, I guess, investing is always driven by fear and greed, but very much so back in March, April, May, June, very much fear and greed. People were fearful, so they took everything out of all the investment, pretty much just stuck with all the cash and treasuries. From there, greed took over. They start to venture into, well, what's the next highest yielding thing? Well, not the money market, well, maybe the stock market. But from there, maybe the precious metals, gold, maybe the energies market, well, maybe the dollar carry trade. So from there, I think right now we're seeing a little bit of going back to the so-called normalcy. Rather than all fear and greed driven, people are starting to looking at the fundamentals. They're starting to look at a little bit of valuation. So if you look at it, if again the U.S. economy were to recover, I think that's the big buzzword these days, then sooner or later, a little bit down the road, maybe starting the third quarter of next year, that the Fed will probably have to start raising interest rate. When the Fed does raise rates, the U.S. dollar is going to be on an even more solid ground. That's why I actually like the dollar going forward.
Yeah, Yu-Dee, Fed interest rates, that really seems to be the wild card, doesn't it? Do you think they'll get the timing right in terms of withdrawing stimulus and normalizing interest rates?
Wow, that is the million-dollar questions. Basically, U.S. put in, what, $787 billion of stimulus. Even China put in $580 billion of it. How do you withdraw that? Do you withdraw at the right time? That is the question. I think overall speaking, the Fed will probably do the right thing, because we do have some experience already. Not me personally, but the Fed. I think they just have to do it at the right time. I think one thing that's really in favor for the Fed, or in Fed's favor, is that we are not seeing any inflation right now, so they could actually take their time a little bit.
All right, good to know. Fingers crossed. Yu-Dee Chang, I'll have to leave it there. Thank you. Happy New Year. We'll see you in 2010. Yu-Dee Chang from ACE Investment Strategist here on